adjustments need to be made. The Fed needs to make some adjustments.
All right. Unbelievable. You guys, thank you so much. Anna Wong, Chief U.S. Economist at Bloomberg Economics out there in D.C. Michael McKee right here in studio, our Bloomberg News International Economics and Policy Correspondent. And Ira Jersey, our Bloomberg Intelligence Chief U.S. Rate Strategist out there at BI headquarters in Princeton, New Jersey. And Claudia Sahm, of course, joining us as well. Read more, too, about her Sahm rule and how we're looking at it when it comes to today's jobs report. You can find it at Bloomberg.com.
All right, much more coming up in just a few minutes. First up, though, we'll check on the day's trade and top business stories. Here's an update from Charlie.
All right, I thank you very much, Tim and Carol. We've got just about an hour, 35 minutes to go ahead of the closing bell. The Dow, the S&P, NASDAQ right now, they are all deeply in the red. That has been the case since we opened trading this morning. S&P right now down 123 points at 53.23. For the S&P, that is a drop right now of 2.3%. Dow Industrials down 811 points now, lower by 2%. The NASDAQ Composite Index down 471, a decline of 2.7%. We've got the 10-year yielding 3.81%, 3.81 on the 10-year. The 2-year right now at 3.90%. Gold is down 0.6%, 24.32 the ounce, while West Texas Intermediate crude oil down 3.6%, 73.60 for a barrel of WTI. Chevron is relocating its headquarters to Houston from California after repeatedly warning that the Golden State's regulatory regime is making it a tough place to do business. Chevron lower now by 3%. ExxonMobil also lower today. Exxon, after earnings this morning, down now by about 0.7%. So again, recapping here, steep losses for the U.S. equity market. Jobs Friday, S&P down 2.3%, 10-year yield 3.81%, the 2-year right now 3.90%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. If you missed any of that conversation, be sure to download our podcast feed a little bit later on. We're going to stay with the jobs report, as we should, on this Friday. As you know, just quick rehash, Charlie mentioning unemployment rate rose to its highest level in nearly 3 years. It does suggest a faster deterioration in the labor market than previously thought. Although, as our roundtable confirmed, Tim, it's not like the world is falling apart.
No, I mean, if you look at certain parts of the market, it might look like it a little bit, but we're only back to June levels on the S&P 500, which is important to keep in mind. Still up more than 11% for the year on the S&P. Let's do some of the numbers here. Non-farm payrolls rose by 114,000. It was one of the weakest prints since the pandemic. Job growth revised lower in the 2 prior months. The unemployment rate did unexpectedly climb for a 4th month to 4.3%. It triggered that closely watched recession indicator, and it has been hammering stocks. So let's get to the interview.
Let's do it. Alan Guarino is with us, Vice Chairman at the Global Organizational Consulting Firm. We are talking about Korn Ferry, and he joins us here in studio. How are you?
Carol, I'm well. Thanks for having me.
It's really
good to see you.
It's great to have you here. And, you know, today's slowdown in the job market, we're talking obviously a lot about it. Does it surprise you?
Not at all.
Why?
Yesterday I said 100,000. So we're better than I thought. Obviously, everyone has the same lens, right? We've seen the direction of travel. You had a massive shock to the system called COVID. That resulted in decimation of jobs. Okay, so now we had this reaction to that, which was the Great Resignation, massive hiring, a recovery, right? So now we're reverting back to the mean. I'm not surprised at all. And there are a lot of forces here that could actually be very beneficial to companies.
Talk about that a little bit. How is that beneficial to companies? If the labor market weakens, you know, the salary pressure won't be there, the wage pressure won't necessarily be there. But talk a little bit about that. What you're hearing from
Not great for workers, though.
Yeah. Maybe for both. Maybe for both. So the best time to buy is in a buyer's market. So if I'm an employer, I'm a buyer. This is a buyer's market. People want to move. All of our research says that. We just did Korn Ferry Workforce 2024. People want to make changes. Guess what? Not a lot of demand for them to make changes. So guess what? That's the time, if you're an employer, to be smart, because employment and building a team is a long-term game. Mm-hmm. So people wanting to move, lower demand. If you're in the market as a buyer and you're smart, you're going to be gathering this great talent right now when you have less competition.
If you're in the market as a buyer, that's a very important word to use, because what if you're concerned about your business not growing at the same rate that it grew over the last 3 or 4 years? You're worried about weakening labor force, meaning a consumer is not as strong, and therefore your revenues are going down. Are you actually looking to hire people in an environment like that?
Great question. building companies is a long-term business. So I'm absolutely going to get that talent today, and it will pay me massively in 12, 24, 36 months. That's what CEOs get paid to do. Make those bets, take the risk. And by the way, many won't. If you do, you're going to win.
This is one perspective to the story. If I'm a worker, and once again, I'm not going to necessarily, I'm going to get pushback on higher wages, which we finally have seen some progress in. If I am, I don't know, that I feel like then the worker loses some ground, or that companies are going to be very careful in terms of efficiencies and costs, which they have been for a long time. Does the worker get hurt, which makes me concerned about consumer spending and what it means for the economy, which ultimately will roll back into whether it's publicly held companies or the economy overall?
Great question. We have a range of workforces in the country, right? But if we look at professional level employment, then again, careers are a long-term game as well. While we don't have the same percentage increase in compensation when people are moving today, they still are increasing compensation. And remember, that compensation increase over the last 4 years has been dramatic. So if I'm already making really good money and I only get another 3% when I move, that's still a lot more than the 3% you would have gotten before COVID, because it's off a higher notional number. So don't let the percentages fool you. People are making more money when they move, maybe not as dramatically on a percentage basis as before, but they're getting great compensation.
Who are these people that are moving? The only reason I bring it up, we have a great story on the Bloomberg this past week about Walmart workers, and apparently a lot of angst over a relocation plan. Basically, the retailer is saying, we don't want you working from home. We don't want you working from other places. We want you all back to Bentonville, Arkansas.
Right.
And
right.
the workers are not so happy about it.
No, and that's a whole other topic, workforce deployment. I was talking about this certainly during COVID and after COVID. I think the new world of work at this point has clarified itself. It's a barbell. You're going to have a percentage of companies that are basically office-centric, and that's probably 20%, pick a number. You're going to have companies that are fully remote, same 20%, probably on the other end of the barbell, right? And in the middle is the hybrid model, right? How many days a week are you going to be in an office versus working virtual? That's a strategic decision, again, for a smart leadership team to decide on. And it really is a trade-off between what do employees want and what are employers willing to give. Ultimately, the employee votes with their feet. You can't make them work for you. So you have to create a work environment they want. Workforce 2024 at Korn Ferry will tell you that people put compensation and workplace flexibility as the number one and number two thing they're looking for, and a great boss is right up there with 2.5. So you get those right as an employer, you're going to do fine.
Across industries, across
pretty much across industries, yeah, for the professional levels.
Okay.
You said earlier that today's weaker than expected payrolls report was not at all surprising to you. You thought it was actually going to be weaker than it was. Do you see a recession coming?
Boy, not a macroeconomist, and I think.
But you talk to a lot of companies that are preparing for the macro environment.
I know, it's a great point. What I would say I'm hearing is what you already heard 100 times today and 1,000 times in the last week and a half. Leaders are cautious and are concerned about the pace of growth over the next 12 months. Again, if they're smart, you take advantage of that as an opportunity to get positioned to grow. Really great companies actually come out of real recessions, right? You've seen tremendous performance post a recession because, God forbid, the phrase, don't waste a good crisis. So honestly, I would tell you that, look, with Volcker, we had 11% unemployment, right? That's catastrophic. We're not going there. This is a typical cycle. We haven't seen one in a long time. I don't know if we have recession or not.
So I think about lots of things that I'm sure come up in your world and with your clients, Alan. And I think about the external forces, whether it's AI, whether it's U.S. politics, whether it's geopolitics, whether it's climate change. I do wonder, what are they thinking about? What occupies their minds so much? Obviously, getting the workers they need. But when it comes to strategies going forward?
Well, what occupies their mind, I think, is the workplace dynamic of today's business playing field. Pace, complexity, globalization. Since 2007, and certainly since the last decade, that has really driven what happens in the workplace compared to 2 decades ago. So what do I mean by that? I mean, a decade ago, certainly 2 decades ago, work and business was a Division II sport. Yeah. Today, because of pace, complexity, and globalization, it's a pro sport. which basically means that you need great talent in order to do well or really outperform. Good talent isn't going to cut it. And by the way, in a professional playing field, there are less people who can perform great. So that to me is what's happening today, what's evolved over the last decade because of those three things, and is going to simply continue to accelerate. That's why at the end of the day, great talent makes the difference. Doesn't sound brilliant, it's not, but it's also hard to get.
No, I think about all the CEOs that come in and they talk about the importance of talent. We got to run. Thank you so much. Have a great weekend. So much fun.
Great to be here.
Alan Guarino, Vice Chairman over at Korn Ferry, everybody.
Still to come, Intel plunging the most ever. What's next for the once almighty chip maker? Before that, though, a check on the latest world and national news. We got Nancy Lyons in the Bloomberg 99.1 newsroom in D.C. Hey, Nance.
Thanks, Tim. The virtual roll call vote by Democratic delegates to pick a presidential candidate is not slated to end until Monday, but the Democratic National Committee says Vice President Kamala Harris has secured enough delegates to win the nomination. She says she's honored to be the presumptive nominee and will accept the nomination officially next week. Former President Trump says there is no reason to participate in a presidential debate against Vice President Kamala Harris. He says everybody already knows both of them. He spoke today with Fox Business.
There is more enthusiasm for how can you be enthusiastic? How can you be enthusiastic about Joe Biden? Okay, I mean, how do you be? But I think she's actually worse. I think she's a horrible candidate because she wants open borders. She was a border czar. She tries to, deny that now, which is not working.
The Harris campaign is launching a new strategy and running ads in papers in the cities where Trump plans to hold rallies, saying he's afraid to debate after saying he would debate anytime, anywhere. FTC Chair Lena Khan says her agency is taking a look at grocery prices and why profits for grocery chains remain so high, even though costs appear to have come down. She says no American should be paying inflated prices due to illegal business practices. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Nancy Lyons.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. Stocks lower across the board. The S&P 500 index poised for its worst reaction to jobs data in almost 2 years. Right now, we have got the S&P down 115 points, a drop of 2.1%. The S&P at 5330. Dow Industrials lower by 780 points, down 1.9%. The Dow right now 39,564. NASDAQ lower by 2.6%, down 440 points, while the Russell 2000 index of small cap shares down now by 3.7%. 10-year 3.80%, the 2-year 3.89%. Spot gold down $17 the ounce to $24.29, a drop of 0.7%, and West Texas Intermediate crude down 3.4%, $73.74 a barrel. Also weighing on sentiment today, tech earnings. Intel shares suffering their largest decline ever. We have got Intel now lower by 26.7%. Amazon after earnings down 8.9%. Apple, though, holding on to a gain after earnings. Apple shares right now up by 2.4%. So again, recapping here, steep losses for the U.S. stock market. Jobs Friday, the S&P now down by 2.2%. 10-year worth repeating 3.80%. That 2-year 3.89%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Something Charlie's been covering, we all have, since those earnings broke yesterday after the closing bell. We're talking about Intel. Shares plunging nearly 30% at their lows today after the company gave the growth forecast, a really grim one, if you will, and also laid out those plans to slash 15,000 jobs, signaling that the chip maker is ill-equipped to compete in the artificial intelligence era. The stock down the most ever.
Yeah, for more on the company, what it was and what it is and what it's going to be, with us is Bloomberg Intelligence senior semiconductor analyst Kunjan Subani, joins us from San Francisco. Kunjan, you write in a note out just in the last half hour that it's hard to find a ray of hope in Intel's earnings. Is there any hope?
Not near term in terms of a fast structural turnaround. I mean, look, the revenue were a miss, which to an extent you can explain because the end market dynamics are getting worse. A lot of other semi peers also highlighted macro weakness in certain areas that Intel is also exposed to. But the weakness in the PC and data center was surprising to us, given that their peers have actually given guidance of strong growth in those areas.
Yeah, surprising is one way to put it. You say that the $10 billion OPEX and CAPEX cuts and dividend suspension seem like a Hail Mary pass to stabilize liquidity and offset slower near-term growth. What's going on?
Yeah, I mean, look, that is not going to structurally change the turnaround. That is not going to likely aid in a faster growth, which is what you really want. But to give them credit, look, that does sort of help stop the bleeding or reduce the pace of the bleeding, right, in the near term. It does give them some cushion and a lower bar and a lower base to begin with now. And even if, let's say, what they implied would be that the revenue growth is not coming very fast very soon, gives them some liquidity to continue investing towards the goal, getting to the Intel A, bringing back the chips that they have outsourced, which have caused a large portion of the gross margin miss that we saw.
You know, you mentioned the liquidity, and that part in the press release jumped out for me. Concerns about liquidity, cash flow they highlighted, and as part of the reason for suspending that dividend. Walk us through their cash position, their liquidity, maybe concerns, maybe their credit picture. Do investors need to be worried? I mean, the stock is now down on the equity side of things almost 60%, 60% this year.
I mean, the OPEX and the CAPEX cuts, as well as their smart capital program and the 2 deals that they have done recently for their Ireland fab and the fab in the US, brings in a pretty good cushion of cash inflow. So I think that on that part, they should be okay now after they implement this. Also, they brought down their CAPEX targets significantly, especially their net CAPEX targets, almost less than half than what they were before. So look, that should give them enough cushion to continue investing, rather at a lower pace, but still continue investing, even while, let's say, gross margin and revenue takes some time to come back.
Does the world still need an Intel? Does the semiconductor space still need an Intel, Kunjan?
I mean, given the CHIPS Act and the geopolitical landscape that we have seen over the last 12 to 18 months, right, sort of Intel has positioned themselves to be the North Star of onshore leading edge manufacturing. I mean, they are still, these dividend cuts and these liquidity programs will help them to continue that investment path and not sort of hold on or suspend them. So that is still critical if you think a hedge away from Asian manufacturing, especially the China risk and the US-China tensions.
Kunjan, biggest customers of Intel include Dell. 19% of Intel's revenue comes from Dell, according to Bloomberg analysis. Lenovo, HP, Alphabet's up there as well. What do you think customers are thinking about buying from Intel in the future after seeing a report like this?
I mean, I would not think anything should change there. I mean, look, what's really happening, the two biggest segments, which the names you mentioned are the customers, is the PCs and the data server, right? What's really happening in data server is they just missed the AI train. Most of the spending right now is going towards AI accelerators, and you see their peers, NVIDIA and AMD, cashing in on it. Doesn't mean Dell and their customers are going to stop buying and selling Intel CPU-based servers, because they still have the majority share in the market. It's just when you think about share loss, you think about incremental share gains or growth, that's just slowing.
You know, I think about the bigger, broader space, Kunjan, and I think Apple, Dell, Meta, others that, have had tough times in their kind of corporate life and corporate history. Having said that, when you think about Intel historically, which was the semiconductor company, right, that everybody kind of, measured themselves against, certainly the U.S. companies, how do you think about Intel's next historical chapter and where it will be or where it needs to be, and can it get there?
I mean, look, the near term seems to be that likely will be a struggle and uphill climb. I think a couple of significant tectonic shifts need to happen in the market if Intel wants to get back to that milestone, right? One is, right now the trend seems to be moving all to GPUs. And again, they're like at least a year or more behind in that area. We did not see an upside to their Gaudi accelerator guide for the full year, which would have been at least a good sentiment if they gave an upside. So, I mean, if the landscape, there's a theory that as things move to inference, landscape moves back to CPUs, away from GPU. I mean, look, if that were to happen, then that could be a big win and a big tailwind for them. And the other big inflection or sort of an option play would be this AI PCs. Look, if AI PCs do drive the significant refresh and upgrade cycles and the new wave in a PC, overall PC growth market, that could again aid them to get back to that position quicker.
I'm curious about the 15% of the workforce that is going to be cut by the end of the year, Kunjan. What do we know about that part of the workforce, what they work on, and the types of jobs they could go to?
So far, we have not received any incremental commentary or information from the company. It seems to me it is going to be in a wider area rather than just one division. It seems from when we talk to the management, they are trying to increase the efficiency, change the structure of how the manufacturing unit works as an independent manufacturer and the fabless, the product unit should work. So it looks, if I had to guess, it would be more broader across the board.
All right, we're going to leave it on that note. Kunjan, thank you so much. So appreciate you weighing in on what's a really important story for us, certainly on this Friday. Kunjan Subani, he's senior semiconductor analyst with our Bloomberg Intelligence team, joining us there from San Francisco. You know, Tim, I was just looking at the SOX. It's down about 10% for the week overall. That compares with about a 3% decline in the NASDAQ 100. It was something we were, been talking about with our team about kind of where we are in this cycle, because we've seen kind of a big rally, a big decline, and it's kind of interesting whether or not we're starting to see a little bit of a retrenchment and maybe what it tells us more broadly about kind of the world overall, especially if we start to see a pullback. It's not just Intel, which is a special story, but maybe
we're seeing a pullback everywhere. I mean, the Russell down 3.6% today, and the major indices down more than 2%.
All right, coming up, everybody, straight ahead, we're going to check in on some of the highlights of the Green Festival.
company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. Chevron is relocating its headquarters to Houston from California after repeatedly warning that the Golden State's regulatory regime was making it a tough place to do business. The move will end the company's more than 140 years of being based in the largest U.S. state and comes amid a shakeup in senior leadership ranks, apparently aimed at improving results. We've got Chevron shares today trading lower by 2.7%, along with the price of oil. Crude today, West Texas Intermediate slumping by 3.4%. ExxonMobil, meanwhile, exceeded profit expectations after the $63 billion acquisition of Pioneer Natural Resources pushed oil and natural gas output. Results provide assurance to investors that the oil giant is well placed to execute a 15% ramp up in share buybacks to $20 billion a year, even despite bearish crude market signals. ExxonMobil shares, they're little change now, down by just under 0.3%. Tesla increased shipments from its Shanghai factory by about 15% in July, snapping a streak of monthly declines in output from its most productive plant globally. Tesla shares lower today by 4.3%. Warner Brothers Discovery says it signed up more streaming customers during 4 days of the Paris Games than the entire Tokyo Games. Warner Brothers Discovery shares today, they are trading lower by just about 2.9%. It is a down day for Wall Street. The Dow, the S&P, NASDAQ, all very much in the red today. Jobs Friday, the S&P down 2.1%, 10-year 3.79%. Those are our top company stories, and this is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio and Television.
It is Bloomberg Business Week on this Jobs Friday. Let's get a check on the latest world and national news. We got Nancy Lyons in the Bloomberg 99.1 newsroom in D.C. Hey, Nance.
Thanks, Tim. The U.S. Secret Service just gave an investigation update. It is admitting to shortcomings in security at Donald Trump's rally in Butler, Pennsylvania, where a gunman fired at the former president. Ronald Rowe is acting director of the Secret Service.
The Secret Service takes full responsibility for the tragic events of July 13th. This was a mission failure.
Rowe says if Secret Service personnel committed policy violations, they will be held accountable. Kamala Harris has secured enough delegate votes to become the Democratic nominee for president. The vice president crossed the threshold of delegate votes during a virtual roll call today, and Harris will officially accept the nomination next week. Do not expect to see a debate anytime soon between Donald Trump and Kamala Harris. Trump, appearing on Fox Business's Mornings with Maria, says he does not need to debate the vice president.
If I didn't do the debate, they'd say, oh, Trump's, not doing the debate. That's the same thing they'll say now. I mean, right now I say, why should I do a debate? I'm leading in the polls. And everybody knows her. Everybody knows me.
Harris has been pressing Trump to follow through with his scheduled debate on September 10th that was to be hosted by ABC News. As for the polls, a Bloomberg News Morning Consult survey conducted from July 24th through the 28th found Harris erasing Trump's lead among voters in 7 battleground states likely to determine the election. Harris is backed by 48% of voters to 47% for Trump. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Nancy Lyons. This is Bloomberg. Now back to you, Carol and Tim.
All right, Nancy, thank you so much. You are listening and watching Bloomberg Business Week. Well, in June, we just wanted to mention something that we did. Actually, Bloomberg did. It was the Bloomberg Green Festival, and it was held in June. It was out in Seattle.
Was it in June? It feels like it was just a few weeks ago.
It was actually not such a long time ago, but it does feel like, considering the news flow. Anyway, it was an incredible gathering, investors, business people. It was folks who make policy. They were talking about opportunities, Tim, and solutions to the climate crisis.
Yeah, one of the folks who was there was Sally Jewell, a former Interior Secretary under President Obama, also CEO of REI, the outdoor retailer. She shared her experience negotiating with oil and gas companies and how they view government regulation, that they just want to know the rules of the road.
Businesses don't hate regulations. They hate uncertainty. That is the killer of business. If I'm making an investment that is going to last for 50 years or 30 years, I want to make sure that I'm going to be able to get a return on that investment and the rules aren't going to change.
Well, there you have it, Sally Jewell, former Interior Secretary under President Obama, also CEO of the outdoor retailer REI.
And it actually wasn't so long ago. It was July.
Was it July?
That's how the news flow has been.
Yeah.
A little crazy, guys, as you all well know. She's one of the voices, though, in a special. We're going to also hear from actor and environmental activist Adrian Grenier, the governor of Washington, Jay Inslee, Stacey Abrams, who you, of course, know from all of her work when it comes to voting rights. She's also talking about the work she's doing on rewiring America, getting electricity and updated systems like air conditioning to people in the rural South, which is something we all know is super important considering how warm everything is right now, really, across the country.
Catch the Bloomberg Green Festival. It's tonight at 8 p.m. New York time, replaying this weekend on Bloomberg Television. And you get a little double dose of Carol Masser in there, too. So that's another reason, too.
It's a fun, I was having a fun conversation with Kara Hertz over at Amazon and Sue Bird, and just talking about using their platforms when it comes to activism and the climate specifically.
I will also say it was just a great event. If you weren't out there this year, I don't know what the plan is for next year, when it is. Go next year. It was an awesome, awesome event.
And we were there on a day where it hit a high in the temperature that hadn't been seen in many, many years. All right, folks, for those watching on TV, the close is up next. Tim and I continuing on Bloomberg Business Week.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
All right, everybody, we are just about 1 hour away from the closing bell on this Friday, August 2nd. Carol Masser along with Tim Stenevec live here on Bloomberg Business Week. Watching the stock market, Tim? Yep, we're down, but we're off our lows of the session.
Yeah, seeing quite a bit of red, though. The S&P 500 at its levels last seen in June, down 2.2%. The NASDAQ down 2.8%. We're going to have more from Charlie Pellet in just a second. Here's why. Jobs, 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 or lack thereof.
Yeah.
The market reaction, the macro, all of it coming up on Bloomberg Business Week.
Yeah, we're going to talk with Torsten Slok in just a moment about all of it as well. Hey, Amazon shares, though, are tanking. They're having their worst day in about 2 years. We've got a roundtable with our Bloomberg Intelligence team looking at all the aspects that is the world of Amazon, what you need to know on this Friday.
And from Bloomberg Business Week, CVS, Target, and other chains have barricaded everything from toiletries to cleaning supplies.
Aisles of locked
Guess what?
Stuff.
It's backfired in almost every way.
Yeah.
Yeah.
It's made me walk out of stores.
Amanda going to join us. She writes about it for Business Week.
All right, let's get you going, guys. Let's get a check with the trade with Charlie Pellet.
Hi, thank you very much. What a day. We got the Dow, the S&P, NASDAQ deeply in the red. We got 59 minutes to go ahead of the closing bell, right to the numbers. That's what you need to know right now. The S&P is down 117 points, a drop there of 2.2%. The Dow down 758 points, a decline now of 1.9%. NASDAQ down 460, a drop there of 2.7%. The 10-year, 3.79%. The 2-year, 3.87%. Gold is down just about 0.8%, $24.25 the ounce. And West Texas Intermediate crude down 3.4%, $73.76 a barrel. The sell-off in stocks today after the weekly jobs report fueled worries that the Fed's decision to hold rates at a 2-decade high is risking a deeper economic slowdown. Now, Federal Reserve Bank of Chicago President Austin Goolsbee is emphasizing that the central bank will not overreact to any one report, adding policymakers will get a lot of data prior to the Fed's next meeting. Goolsbee was interviewed this morning by our Michael McKee.
As I always say, the data dogs, there's a time for walking, there's a time for sniffing. The sniffing time is when there's a lot of uncertainty and you don't know what's what. Once you get the through line, that's the time for walking.
Chicago Federal Reserve Bank President Austin Goolsbee interviewed early this morning by our Michael McKee. Intel down 27% after earnings. Amazon down 9.5% after earnings. We'll have more coming up here on Bloomberg Business Week. Apple after earnings higher right now by 2.2%. So again, recapping here, the Dow, the S&P, NASDAQ very much in the red. The S&P down 2.1%, 10-year bears repeating 3.80%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thanks so much for that update, Charlie. Well, to continue with what Charlie's been talking about, that sell-off in stocks intensifying, bond yields plunging after a weak jobs report fueled worries that the Fed's hold stance on rates is now risking a more pronounced economic slowdown. Equities tumbled, a plunge in key tech companies sent the NASDAQ 100 down 10% from its peak, matching the definition of a correction. You just heard Charlie play some sound from Chicago Fed President Austin Goolsbee. Here's another bit of sound where he spoke exclusively to Bloomberg's Mike McKee earlier today.
We'd never want to overreact to any 1 month's numbers. And if you back up to the last half of 2023, you know that the market said maybe there would be 7 cuts for the year. And then when a month would come in, then that 7 would drop to 3. Then there was a group saying maybe there will be an increase in rates. The job of the central bank is to figure out the through line and to move in a steady way.
There you have it, Chicago Fed President Austin Goolsbee speaking exclusively with Bloomberg's Mike McKee earlier today. We've got a great voice to help us understand the macro environment. Torsten Slok is back with us. He's chief economist and partner at Apollo Global Management, joining us now from New York City. Torsten, when we spoke to you back in March, you said you didn't see the Fed cutting rates this year. Based on today's payrolls report, other data that you've seen since then, have you changed your mind?
Yeah, we changed our view today, and that was on the back of, very importantly, Jay Powell on Wednesday signaling that we are likely to get a rate cut in September. We still have had fairly strong data with GDP growth in the second quarter at 2.8. We had retail sales for June at very strong levels. We'll get new numbers for that for July next week. We'll also get CPI inflation next week. But importantly, if you look at the high frequency data for daily data for how many people fly in airplanes is still strong. How many people go to restaurants is still strong. If you look at the IRS tax withholding data, it's also strong. Weekly data for retail sales is strong. Hotel bookings are still strong. Across the board, the weekly and daily indicators are still signaling that things are fine. So the bottom line is, yes, with this employment report, things are a little bit weaker, and it does fall in line with what Jay Powell was saying on Wednesday. So that's why we do think that we will now get a cut from the Fed of 25 basis points in September.
So what I'm hearing from you is that the sky is not falling by any means, Torsten.
Exactly. So let's just take a step back, and this is really, really important. And you and Carol have talked a lot about this, namely, what is the reason why we should have a recession now? What should be the source? It's not like in 2008 where we had a major bank fail. It's not like in 2000 where we had a major bubble pop in the stock market. It's not like in 91 where commercial real estate was falling significantly. There is no major shock anywhere when you look at the data that is falling apart and therefore can justify why we should see a dramatic slowdown in the economy. So looking about the anatomy of what is a recession, if it normally is either an asset bubble popping, it could be some shock from the outside. It could also traditionally be that the Fed has raised rates too much. Well, if its rates had been raised too much by the Fed, then the Fed can just begin to cut rates. So that's why this whole idea that suddenly from Thursday to Friday, meaning from yesterday to today, that we've had a dramatic change in the economic outlook, I just don't see the justification for that. I still think that we have a soft landing and the market is overreacting to one data point, which, by the way, could also be driven by a hurricane. There's still a lot of debate about that, as you know, today.
Yep, could be a slow your roll moment kind of thing. Having said that, former president of New York Fed Bill Dudley wrote a Bloomberg Opinion column last week. He said he changed his mind that the Fed needed to cut rates now. This was before the decision this week. Democratic Senator Elizabeth Warren, who is on the Senate Banking and Finance Committee on X today, said Fed Chair Powell made a serious mistake not cutting interest rates. He's been warned over and over again that waiting too long risks driving the economy into a ditch. The jobs data is flashing red. Powell needs to cancel his summer vacation and cut rates now, not wait 6 weeks. Is she right? So I'm assuming, based on what you just said, we don't need an emergency cut. There are GFCs and global pandemics, and then there is just another month of data in a trend line that has been showing a softening jobs market, right?
I think that's exactly right. Absolutely, Carol. I think that this is the trend line of the Fed started raising rates in March of 2022. Think about it. That's almost 2.5 years ago. And now we're beginning to talk about, whoa, this is the impact of the Fed raising rates. Okay, if that's the case, well, then, of course, we will likely have the Fed now beginning to cut in September, beginning to signal that they will continue to cut rates as much as needed. But there is plenty of room for them with the Fed funds rate at around 5.5%, still being able to cut if there is a need to get some support to the economy. So I still think, in particular, looking, as Jay Powell said on Wednesday, at the totality of the data, that yes, there is some weakness in the labor market here. Again, there's a lot of debate about how much of the increase in the unemployment rate is because of, again, weather, how much of it because of immigration. There's some special reasons for that. And I think that the Fed is saying, let's take some time here and figure out whether this is something that is more pronounced. If retail sales really weaken next week, that's not what we've seen in the weekly data, that's not what you're seeing in the daily data, then of course we can begin to think about whether this is a more likely scenario. But this idea that sentiment in the economy has changed overnight, the way it did with COVID, we did, as you said, Carol, the way it did with GFC, is just not what's happening in this situation here. It is much more a slow grind. So it is slower, but not crashing.
Hey, I do have one question though, Torsten. Do you have any regrets in your call of saying no rate cuts this year?
No, I think this was the right call in the beginning of the year. I mean, think about the roller coaster ride that we've had in rates markets. So for futures, as you know, which tells you something about what we will have in terms of cuts over the next several quarters. They were predicting 6-7 cuts in the beginning of the year. And that's when we began to say, no, this is just not what the data is saying. So I think it's a very similar situation today. Markets are really getting ahead of themselves, thinking, oh, gee, I want to be the one that predicts that the slowdown is here. I definitely don't want to be the one who didn't predict that the slowdown was here. And I think that the market is not looking at the data that's coming in, and the incoming data continues to be reasonably strong. Sure, it could change, but for now, it still looks like the economy is actually in quite good shape. Just think about it. GDP in the second quarter was 2.8. And if you look at Atlanta Fed GDP now for this quarter is now 2.5. Potential growth in the US is 2. We are above 2 by all measures of where GDP is at the moment. So the conclusion is, it could be that if the stock market really starts going down, that we could change sentiment. But that's just not what the incoming data is showing.
Hey, Torsten, we love it when you join us on Bloomberg Business Week. Our audience loves it too. I'm getting a message from a listener, a viewer, who wants to know what your valuation view is across asset classes. How do you position going into the end of the year?
Yeah, this is a very important discussion. So the very simple observation is, of course, that interest rates are still high. If you compare that where the Fed tells us where interest rates will be over the next several years, that they will be lower. So by that, it is telling you that if interest rates are higher than where they normally would be and where they will be over the next several years, well, then you should conclude, both in equities and in credit, that you should be up in quality. That's why in private credit, if you're first lien, senior secured, top of the capital structure, you get that protection against that risk of a recession being a higher likelihood. So that's another way of saying, invest in companies that have earnings. And I know this sounds a little bit funny. Well, of course, I would invest in companies that have earnings, but that's not obvious at all. For example, in venture capital, you invest by definition in firms that have no earnings. So firms need to have higher coverage ratios, meaning have higher earnings that they can pay for those continued higher interest expenses. That means stay away from enterprise software, stay away from life sciences. Generally speaking, also weaker outlook for tech, growth, some parts of healthcare, some parts of consumer. Areas where businesses have no earnings will continue to struggle, because the bottom line in that discussion is, in the Russell 2000, 40% of companies have negative earnings. That's, of course, not good if interest rates, expenses continue to remain elevated.
Torsten Slok, look forward to your next research report and the weekend reading that you always share with us. Torsten Slok, he is chief economist and partner over at Apollo Global Management, joining us there in New York City. Now we got to talk about something on the equity side of things. We're talking about Amazon, down right now as we speak, Tim, 10%.
Yeah, this after the company told investors that profits for now will take a backseat to heavy spending on AI. Amazon projected operating income for the current quarter that ends in September will be $11.5 billion to $15 billion. Analysts wanted to see, on average, $15.7 billion. That's what you call a miss.
Yeah, you're pulling it in. Poonam Goyal is Bloomberg Intelligence Senior Analyst for E-commerce, athleisure, off-price retail. And Anurag Rana is Bloomberg Intelligence Senior Technology Analyst. Poonam joining us in New Jersey. Anurag joining us from Chicago. Anurag, let's start with you, first of all. The operating income number, how big of that was a shock? And talk to us about the AWS and really the Amazon parts that you follow and what you found out.
Yeah, I mean, you look at it, the growth rate for AWS improved, which is a really good sign. We were a little bit concerned going into the quarter because what happened was when you saw Microsoft's number on cloud, everybody was happy. But when you strip out the non-AI portion of it, the growth decelerated, and it was potentially the same thing could have happened to AWS, but growth was good, margins were really good. All they're saying is they're going to be investing a little heavily into AI and other areas, so you could see some dent in profitability in the coming quarters, and that was our key takeaway.
Why, Anurag, are investors not giving them the slack in the trade today that this will create an ROI that's worth it?
I think it's not the season of getting slack. I mean, you see what happened with Google, frankly. You see what happened with even Microsoft for a little bit. And AWS, I think it's the same story. Because one of the things you remember is over the last 1.5 years, all these companies that I mentioned have had a phenomenal run in terms of the AI play and things that are going through it. This is just a period of pause where they're going to be building more capacity and the growth will come after that.
All right, so let's bring in Poonam. Poonam, to the kind of retail side, when we think about Amazon, a lot of us, right, still ordering, getting stuff, and all that good stuff. What did we see in terms of those metrics, and what jumped out for you?
Yeah, so the retail business was a little lighter. We saw third-party sales, which is the bulk of their marketplace revenue, missed consensus expectations slightly. So I'd say, part of that is a reflection of just the consumers being pulled back. We saw that across retail. We've been hearing it all year. But we do think that as Amazon continues to push the pedal on price, which is also part by the guidance lower for the operating profit, they're going to need to do more of that, right? You saw the unemployment numbers today, and the consumer is clearly getting more worried, and they are going to ask for more values. They are going to be seeking more discounts. And we would think that Walmart and the Amazons would get more aggressive on price.
I do want to also ask you about, their push or looking to get into kind of that less expensive product area, whether it's for the home or for items, going after Temu and some others.
Shein, like shipping directly from China, for example.
Exactly. So what did we get in terms of an update on that, and how important do you think that is to the growth picture going forward on the retail side of things?
So we got no update on that. They didn't talk about that, which is not a surprise. It's actually not active right now. So I know we all heard about it about a little over a month ago, and it's something that I think they're testing right now, but we do expect them to roll it out at some point in the future. It's important that they actually do roll this out, because if you look at the growth that Temu or Shein have had in the last just 18 months, it's been pretty spectacular. And the push is all on price here. And consumers care about the price. So they're going there irrespective of the point that it's going to take 2 to 3 weeks to get here. Now, you can argue that Amazon has a lot more to offer, and I do think it does. If you want something tomorrow, if you want something same day, you don't necessarily think about what you want 2 weeks out. So Amazon does have that advantage, which supports it. And also the offerings span from low to high, right? Where on Temu and Shein, you could argue they're largely at the lower price points.
Anurag, I want to bring you back in here and talk a little bit about what you're seeing in terms of the customer base, what we heard from Amazon about the customer base for AWS and the strength that it's seeing there, especially with the rise of competition from Microsoft and from Alphabet.
Yeah, one of the things I've said many times is the cloud market is big enough for all the three, in fact, maybe even a couple of more to prosper. The size of the market is only growing, or even going to grow bigger because of AI, because a lot of these testing and the workloads that you're going to do in some like of a cloud infrastructure that's sold by either Amazon or Microsoft or Google or Oracle. In the case of Amazon, they have the highest market share. And I think it's for them to protect the market share by investing more and expanding their services. So we don't see really a big gap between the services offered by one over the other. It's just that the market is so large.
Poonam, I want to go to you for advertising gains. I'm curious what we heard from the company very briefly. We got 20 seconds left about how its advertising is growing.
So advertising is growing at a 20% clip, and we expect that to continue. It's going to continue to grow fast, and it has high profit margins. So overall, with Prime Video ads coming back in the picture, with the retail business growing as it is, we think that's a bright spot for them in the future.
All right.
How are we out of time?
Well, because we have a clock and time moves on.
Oh.
Listen, you guys, though, we really wanted to touch on Amazon, and we wanted to get to both sides. So thank you so much. Have a great weekend.
You should have seen the look that Carol gave me when I asked Poonam a last question.
It's like, wait, 30 seconds. Poonam Goyal, be well. Bloomberg Intelligence Senior Analyst for E-commerce, Athleisure, Off-Price Retail, and so thank you to Anurag Rana, Bloomberg Intelligence Senior Technology Analyst. Amazon, though, one of the big decliners in today's trade.
It's 3:21 on Wall Street. We do check markets all day long here at Bloomberg. 39 minutes to go ahead of the closing bell. The question as we head toward the close, just how low can we go right now? We are off session lows, but still a 116-point drop in the S&P 500 index. Jobs Friday, we're down 2.1%. Dow Industrials down 747, a decline right now of 1.8%. We've got the Dow Jones Industrial Average of 39,601. NASDAQ NASDAQ is down 2.6%. The NASDAQ 100 index also down 2.6%, but the Russell 2000 down 3.7%. Again, to put that in context, S&P down 2.1%. 10-year 3.80%. The 2-year yield 3.88%. Spot gold down 0.7%, 24.28 the ounce, and West Texas Intermediate crude oil down 3.5%, 73.67 a barrel. Hiring slowed markedly in July. The unemployment rate rose to the highest in nearly 3 years, suggesting a faster deterioration than previously thought and putting the Fed solidly on a path to cutting interest rates in September. Former Fed economist Claudia Sahm, now chief economist at New Century Advisors, says that triggers her recession indicator, the Sahm rule.
So whether we are at that moment of a recession or not, this is your build into substantial weakening in the labor market. Right? Like we have seen potential. All is not lost. We are, the bottom's not falling out. We should never panic. There are policy tools, there are levers. And again, I don't overread one data point, but this isn't one data point.
Claudia Sahm of New Century Advisors. Recapping, S&P down 2.2%. We have got the 10-year yielding 3.79%. And Bitcoin down 3%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thanks so much for that update, Charlie Pellet. You just heard it from Charlie. Bitcoin down 3%. It was down as much as 3.5% earlier in the session. Ether down today at more than 5%. So a good day to check in with Michael Anderson, the co-founder of Framework Ventures. It's a VC firm focused on the blockchain industry. Framework Ventures investments include Chainlink, Synthetics, The Graph, and dozens of other companies. Michael joins us from San Francisco. Michael, how are you?
Doing well, thanks. Thanks for having me.
Yeah, good to have you with us. The ups and downs of the crypto industry, it's certainly volatile. I'm wondering, as a venture capitalist, what you're seeing out there in this space and how you could describe the landscape to us right now.
Yeah, well, our approach at Framework is that we're finding and backing the best founders in the space. We don't have to live with much of the market vicissitudes because of that. We're early stage investors. But I think if I was to have one kind of soundbite for 2024, I think 2024 represents the time of institutional adoption for crypto. We saw this with the Bitcoin ETF getting launched in January, most successful Bitcoin launch of the 11 providers. We just saw 2 weeks ago the Ethereum spot ETF launch. It's on track to do extremely well as well and bypass all expectations. And so we think the rest of the year, the first half of the year, maybe it was all about Bitcoin. I think the rest of the year is going to be all about Ethereum.
And over the weekend, we saw the former president and current Republican nominee for the White House, Donald Trump, go to the Bitcoin conference and profess his love for the cryptocurrency. Michael, does it matter to you who wins the election in November?
So it's a great question. What we know is that the Republican side of the campaign right now is very pro-crypto. They have been coming to events. They have been talking about it. It's part of the platform of the Republican Party. What we are waiting to see is what the Democratic Party will put together as part of their platform. So it's a bit of a wait-and-see program right now in terms of whether or not this technology can become bipartisan. But that's the goal. We want this to be a bipartisan effort so that it doesn't really matter who gets elected in November or this industry to continue to flourish. What we're really waiting for and what the entire industry has been hoping for is a playbook for entrepreneurship to come back to the United States. What we've seen over the last few years is without a clear set of rules and guidelines, entrepreneurs are moving outside the US and starting their companies in Western Europe or in Asia because there are playbooks and regulatory frameworks over there. We would love to see that come back, and that's hopefully what a bipartisan effort would bring.
Michael, I'm interested in your thoughts on Gary Gensler because President Trump pledged to fire Gary Gensler over the weekend if he does become president again. And it's interesting to hear that and hear that Gary Gensler has been the target of so much ire from the crypto industry, given that two pivotal things you just mentioned a few minutes ago, the launch of the spot Bitcoin ETFs and the launch of the spot Ethereum ETFs happened under his watch. How do you view him, and do you think he's as much of a lightning rod as other folks in the industry do?
Well, so on the first point, I think the catalyst for the Bitcoin ETF launching in January had to do more so with the finding against Grayscale, which favored Grayscale in that decision. And frankly, when we think about what the future of the SEC could provide for the industry, is there are a lot of great ideas. Hester Peirce is one of the commissioners who's put forward a concept of a safe harbor for entrepreneurs to be able to have a couple of years to build and develop their product or service and not have to worry about a regulatory overhaul changing the direction of whatever it is that the entrepreneurs are working on. And ultimately, that's what we want to see. We want to be able to have some period of time, a safeguard period of time, or a playbook so that people actually know what to do. And I think that there are a lot of great ideas at the SEC. We would just love to see them come to fruition.
Hey, one thing I'm really interested in, Michael, is zombie chains, because I feel like when all of this was starting years ago, a lot of people, I think, blockchains made a lot more sense. But tell us what's going on and kind of where we are in this, development cycle or developmental cycle when it comes to the use of blockchains.
Yeah, and I think this is sort of the dichotomy between, let's say, Bitcoin and Ethereum. Ethereum you can think of as maybe one of the app stores for these different applications, one of the app stores for finance, and there's a number of others. Just this week, actually, the California DMV announced that they were going to be working on a tokenization of all driver's license in California, 42 million driver's licenses built on top of the Avalanche blockchain. These types of applications are happening. Broadly, you could consider them tokenization or stable coins, or even games. At Framework, we've been investing in the gaming ecosystem for the last 3 years. And a lot of these games, some of these games are hitting multiple millions of monthly actives right now. And the application development is happening, and the growth is definitely happening as well. There are a lot of these platforms, whether it be ETH or any of the other layer 1 blockchains that are working, but there are some that haven't been able to hit that application success. And maybe those are considered zombie chains, but I think the ones that are working are becoming very obvious.
Wait, so are you telling us that we're not going to have to go to the DMV one day and sit in line for hours, and people I know it's a tough job.
You got to have your people go to the DMV for you.
No, you don't. You have to get a picture. You actually have to show ID.
I know you do. It's really
Tim
bad.
lives a really sweet life, a charmed life.
I'm the only person who's ever been to the DMV on my behalf, unfortunately. I have the stories to prove it. Don't forget a pencil or a pen at the Brooklyn DMV.
How many forms of IDs and the points?
Do not forget a pen. Let me tell you that.
Michael, what I am curious about, Tim has had numerous conversations, both of us have, over the years. How are you thinking about, especially as an investor, and thinking about kind of the startups in this space, how the interest and, the companies in crypto or blockchain that make sense, that it's where the money is going, and maybe how that has changed over the years?
I think a lot of the original ideas of blockchains are continuing to be the ones that are working, and we're continuing to see the success of them. And what I mean by these is, at one point in time, it was maybe called DeFi. I think the way that DeFi is maturing is really just tokenization. And tokenization is something that Larry Fink is talking about, on Bloomberg itself. Those types of opportunities for maybe the tokenization of all assets is something that we think is over the next 10 years, 20 years is absolutely going to happen. I mentioned games. Games is another category that we're really excited about.
What does the tokenization of all assets really mean? Help me understand that.
Yeah, so I think we could think about it in terms of driver's licenses. We could think about it in terms of equities. We could think about it in terms of bespoke credit swaps that may be traded or transacted. All of these assets, in the same way that we had the electrification of markets, we think that there will be the tokenization of markets, which provide more transparency, cut down on costs, and are really just infrastructure that makes these markets more accessible and available.
So does that mean we won't need a lot of Wall Street firms? Or all these trading firms?
I think Wall Street will adopt this technology in the same way that they adopted the internet and electronic trading mechanisms.
Hey, Michael, as a VC, what's exciting to you right now? What's the stuff that people are coming to you with? What's your staff going out and finding that makes you want to spend money on it?
There's a lot of things. For fear of running right into sort of the market narrative zeitgeist of traditional Silicon Valley, some of the obvious or really interesting things that are happening right now are the intersection of AI and crypto. And what I mean by this is it's pretty obvious that when we're talking about AI agents that are working in consuming consumer computer services, they're not going to be able to start a Wells Fargo account or a PayPal account. They're going to transact with money on blockchains. They also need ample amounts of data to be able to train models or use the data for inference. The ways that data will be transacted will also happen on a blockchain. There will be a lot of overlap in the things that we're seeing with OpenAI or Llama and how those models are proliferated and delivered to customers, and blockchains will be an underpinning element of that for sure.
You ready for the tokenization of all assets?
Hey, I'm ready to not go to the DMV. that's like, and I'm ready to stop paying title insurance.
I know.
That would be nice to not pay anymore.
There's some things that would make so much sense.
There's a lot that would make sense. Michael Anderson, appreciate you coming on. Come back and hang out with us soon. He's the co-founder of Framework Ventures. It's a VC firm focused on the blockchain industry, joining us from San Francisco. Chainlink, Synthetics, The Graph, and like 50 other companies on the website that they've invested in. Hey, we're going to drive to the close in just a few minutes.
Yes.
Before that, though, let's get a check on the latest world and national news. We've got Nancy Lyons in the Bloomberg 991 newsroom in D.C. Hey, Nancy.
Hey, Tim. The acting director of the U.S. Secret Service, Ronald Rowe, says the agency is reviewing its failures in protecting Donald Trump during the recent Pennsylvania rally. Bloomberg's Irv Chapman has more on an investigation update this afternoon.
Rowe said it would require a substantial technical fix for the Secret Service to hear local police communications on their search, in this instance, for an armed suspicious person.
We didn't have access to certain information, not by anybody's fault. There might have been radio traffic that we missed in the final 30 seconds, which has been the focus of what happened before the assailant opened fire. There was clearly radio transmissions on that local radio net that we did not have.
Rowe said state and city police are needed to augment his agents with knowledge of the venue, as well as such local laws as open carry of firearms. In Washington, Irv Chapman, Bloomberg Radio.
Vice President Kamala Harris has secured enough votes from Democratic delegates to officially be the party's nominee for president. She reached that threshold today during virtual voting, and she addressed her supporters.
I will officially accept your nomination next week once the virtual voting period is closed. But already I'm happy to know that we have enough delegates to secure the nomination.
The online voting process will continue until it wraps up on Monday. The voting was moved online to meet an August 7th deadline for endorsed candidates to make the Ohio ballot. Harris's campaign says it raised $310 million in July. That far outpaces former President Trump's contributions of nearly $139 million. Two-thirds of the donors to Harris's race were first-time donors. She has erased Trump's polling averages in several swing states as well. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Nancy Lyons. This is Bloomberg.
It's 3:40 on Wall Street. We do check markets all day long here at Bloomberg. Steep losses for the U.S. stock market. We are off session lows, but let's head right over to the first word breaking news desk for today's afternoon call. And here she is, Feliz Marantz.
Good afternoon, Charlie. Stocks remained under pressure all day, with tech stocks dragging on the broader market. Intel's down a stunning 26%, and Amazon's off around 9%. The Dow down 1.9%, S&P 500 down 2.3%, and NASDAQ down 2.8%. The U.S. 10-year yield is at 3.79%. The Russell 2000 small cap index fell as much as 4.4%, and the VIX jumped to nearly 30. All of the 11 main S&P 500 sectors are trading lower, except for a slight gain for consumer staples. Consumer discretionary and financials are leading declining sectors. Leaders in the S&P 500. Intel's the worst performer, followed by Prudential, Microchip Technology, and Micron. Clorox and GoDaddy lead gainers. In other news, the S&P 500 is set for the worst jobs day in 2 years. JP Morgan and Citi see the Fed dealing 2 supersized rate cuts this year. Trump is pushing back on a debate with Harris, saying he's up in the polls. And wrapping things up, a New Jersey transit breakdown trapped commuters for hours with no air conditioning. Live from the First Word Breaking News Desk, I'm Feliz Marantz. Charlie?
All right, I thank you very much, Felice, and to hear live breaking news over your Bloomberg, type SQUAK, S-Q-U-A, on your Bloomberg terminal. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, you know what we like to do. TikTok, everybody. 18 minutes left to go in today's trading session. Getting ready to wrap up the day and the week. And, yeah, equities, across the board kind of lower here. But I should point out that we are definitely off our lows of the session. I always like to add some perspective. It'll be interesting to see what happens as we get closer to the closing bell. However, almost 400 names in the S&P 500 are lower in today's session. 110
you know
are
what?
higher.
I feel bad for anyone who has to come up with 3 or 4 gainers today.
That would be me.
Yeah, you find them?
Do you know what's the number one gainer in the S&P 500? You probably use the products. Maybe you don't, because I don't know. Everybody's been pushing back against bleach.
Clorox?
Number one gainer in the S&P 500.
Okay,
Happens to be a gainer.
Look, perspective, we're up 11.6% on the S&P 500
You know what the number one decliner is, which was
Intel.
Easy for you. Yeah.
Yeah, that's going to be my first decliner. I want to see what Andrew Cry has to say about today's market action. He's co-chief investment officer at Crescent Grove Advisors. They've got about $4.7 billion in assets under management. Andrew joins us from Milwaukee. Andrew, you getting a lot of calls today from clients at all who are concerned?
Fortunately, no calls today. So either they're well-trained.
I was going to say they're trained well. That's exactly what I was going to say.
Or, they I think have a similar take to us, which is, let's think about signal versus noise here. Is this real signal in terms of, is this jobs report really suggesting that we're heading towards a full-blown recessionary scenario, which seems to be what we're pricing in at this point? I mean, this sort of magnitude of the move that we're seeing within fixed income, within, short-term rates markets is just really dramatic relative to what we think is sort of the broader context of economic data. So, perhaps, again, we would sort of make the distinction between signal and noise in this environment.
So you think the weaker than expected payrolls report that came this morning and the revisions that we saw to last month, revisions lower, you think that's more noise than signal?
You have to, look, you have to take it at face value for sure. There's clearly been a weakening within the labor market. There's no doubt about that. But I think, one of the things, I think the San Francisco Fed had pointed to this, others have pointed to this research, talking about the immigration sort of effect on the unemployment rate, and talking about the SOM rule and all those sorts of things that would be triggered, where we've seen the unemployment rate tick up. We think you have to take, again, the whole context of what we've seen within the labor market, and you look at the other measures as well, whether that's, ADP, whether that's, challenger job cuts, whether that's JOLTS data, all these sorts of things, the overall mosaic, initial claims, ongoing claims as a percentage of the labor force. All these sorts of things suggest to us that we're just cooling off of a extremely hot level. So I don't know that this dramatic of a response is warranted in this case.
So Amazon's down almost 10%. Intel is down about 27%, just picking two names on the decline today. If things aren't as bad, Andrew, and I could certainly talk about some of the other decliners in today's session, does that mean that this is a buying opportunity, at least when it comes to the equity universe?
Well, so we would, I think, take tech on the one hand versus everything else on the other hand is kind of how we've been looking at it. And in so much as I think tech is just traded at a too rich of a premium relative to the rest of the market. Now, it was warranted as you go back and look at the earnings growth differential that we saw 12, 18 months ago. But as we approach the second half of this year and into Q4, where this earning growth differential starts to converge between, the Magnificent Seven, let's say, sort of take those as the poster children for the tech rally relative to S&P 493, the rest. I think you start to see that earnings growth converge. That's where I think there's the opportunity for sort of a rotational trade. So we wouldn't be necessarily as all in on some of those tech leaders that perhaps have seen a little bit of weakness, but we'd be thinking more about how can we rotate into some things where the bar has just been set a little bit lower going forward.
How does it look going forward from here? If you're seeing people out there today buying because they see this as a buying opportunity, and look, we are off our worst levels of the day. Do you advise? And look, I can't time the market, but if you're thinking, or so I'm told, I'm not saying you can or can't.
Yeah.
If you're looking out ahead, do you see this as a buying opportunity, or do you think people should sort of sit back and wait for the dust to settle?
Yeah, I think longer term investors, right, we put on our allocator hat and we say ultimately you want to have an allocation to stocks. You want to take advantage of periods where there's weakness like this, to incrementally add to names, to exposures that you want to have in your portfolio. And right now we think that tends to be more on kind of the value side of the equation, which could be some things that might be a little bit more pro-cyclical, but also a little bit more defensive in nature. That tends to be kind of the makeup of the value indices. And then even some folks that have been so home country biased, so heavy overweight to the U.S. and those big tech names, take a little bit of, an opportunity here to rotate into some non-U.S. names, perhaps. Let's look at EMX China. Let's look at Europe. Let's look at Japan, where the data hasn't been, setting the world on fire, but it's inflecting higher. And we think there's still an underpinning of global growth recovery at this point. Whether you look at export volumes, whether you look at sort of early indicators on PMIs, those sorts of things, to suggest that, again, from a relative value rotation perspective, that's where the opportunity is going to be over the next 6 to 12 months.
Yeah, Arjuna Martin Adams talking about, right, branching out in terms of the global equity universe and how Fed policy can certainly play into that. Where do you not want to be? And I'd love you to take us to the fixed income world, especially as we have watched quite a rally over the last couple of days, certainly since the Fed meeting. Where do you want to be when it comes to the U.S. Treasury curve?
Well, I think that you hit it with the rally that we've seen, and thinking about a fresh dollar going to work today in the fixed income market. I think we just want to fade this idea that we're going to get a dramatic amount of rate cuts over the next year plus, right? I mean, if you look at, I was looking at the SOFR futures curve going out to the end of 2025, end of next year, pricing in about a 3% Fed funds rate. We just don't think that we're going to see that magnitude of cuts from the Fed in that environment. Because we're going to see sticky inflation. We're going to see growth that's reasonably okay. You look at as a related aside, the Atlanta Fed GDP now still running in the mid twos. If you look at their PCE forecast and come up with a nominal GDP forecast, that's still around 5%. We just don't think that meaningful cuts to the tune of 200 plus basis points are warranted. So in that case, you want to favor some shorter duration instruments within fixed income, because we're not going to see the full realization of what's being priced in at this point.
How many rate cuts? Just 30 seconds. How many rate cuts do we have this year?
Well, I'll tell you, the market's pricing in nearly 5 by the end of this year.
What do you think?
We tend to think that, perhaps the Fed goes 50 if they want to, use the Jackson Hole meeting as sort of the forward guidance period for them to tee up, 50 in September. But I just tend to think that, they've been a little bit more incremental all along the way getting to this point. I think they're still rightfully concerned about inflation being sticky.
Right.
So, 25 a meeting seems about right.
Andrew Cry, Co-Chief Investment Officer at Crescent Grove Advisors, joining us from Milwaukee.
Hey, coming up next, we're going to be joined by our Bloomberg TV team for our cross-platform coverage on radio, TV, YouTube, Bloomberg Originals. We are counting you down to the close.
company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. 7 minutes to go ahead of the closing bell, and until we wrap up a turbulent week for the U.S. equity market, and we have got Intel shares plunging today by 26.7% after the company gave a grim growth forecast and laid out plans to slash 15,000 jobs, signaling that the chipmaker is ill-equipped to compete in the artificial intelligence era. Intel, after earnings again, now down by 26.5%. Amazon, also after earnings, lower now by 9.2%. It told investors that profits for now will take a backseat to heavy spending on artificial intelligence. Mandeep Singh is a senior tech analyst with Bloomberg Intelligence.
So with Amazon, I think they had a mixed quarter, but the real difference between an Amazon and the other mega caps is in terms of capital allocation. Amazon still doesn't have a dividend. They're still not that big on buybacks compared to, your Alphabet, Meta, and Microsoft. And that's where the capital allocation does make a difference. I mean, Apple, look, they're not spending on CapEx, but we know they spend big on buybacks. And that's where it makes a difference to an investor holding one of these mega caps.
Again, Amazon down now by 9.1%. Mandeep Singh, by the way, with Bloomberg Intelligence. And yes, you can hear more of that conversation on the Surveillance podcast. You can download it wherever you get your podcasts. And sticking with corporate earnings, big tech specifically, Apple shares are advancing after last night's report. We got Apple right now higher by just about 0.7% so far this year. Apple up by 14.9%. Those are our top company stories at this hour. I'm Charlie Pellet, and this is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio and Television.
It is Bloomberg Business Week on this Tuesday.
Getting all my
Wait, did I say
earbuds.
Tuesday? No, the second day of August. Jaws Friday.
Bloomberg Green was in July.
Yes.
Let's get that straight.
Yeah, not
Check
June.
out that special on TV at 8 p.m.
Yes,
tonight.
do it.
Yeah.
Carol is the star of the special.
I am not the star. The people who were there.
Oh,
and
okay. Well,
I'm going to say Meg Szabo, who put that event together, is pretty
Okay.
incredible. Having said that, I don't know about all of you, right? We just talk about every day we come in and we feel like we've gone through several days because the flow of news is just staggering. But just watching a little bit of the reset. But I do think it'll be interesting to see that we're off our lows on the equity side. If we saw some selling going into the weekend, I would think that there was more fear in the markets about maybe the Fed being behind the curve. So it is a moment to kind of take a pause and kind of think about where we go from here. Earnings, Gina Martin Adams reminds us they're not coming undone, and if anything, we're seeing earnings growth broaden out.
Yeah, I was just going to say, if you're a mega cap tech company, maybe think about that CapEx investment. That's what I'm going to say.
Well, do you think about Ed Ludlow when we say, what's the common thread? He's like, CapEx.
Yeah, it really is.
Like, what's going on?
Hey, there's some green on the screen, though, in some places.
Where
We
you
got
finding
consumer
green?
staples higher, we got real estate higher, we got utilities higher. But consumer discretionary, you can thank Amazon for that, is down 4.7%. That's consumer discretionary in the S&P 500.
And I think some of it comes to expectations. You know, you've got stocks that have run up, particular names. I mean, I don't know, Amazon's up about 10%, but it was up a lot more before the haircut of today. It's 10% year to date.
Oh, I was going to say, what screen are you looking at? Because it's
I
not
have
right.
special screens.
Yeah.
No, 2024, it's up 10%. And that's after the drop that we got today. So if you go back to yesterday, it was a lot more
And look,
substantial.
I'm going to say this again. If you look at the S&P 500 year to date, we're still up double digits, up 12% now year to date. Nasdaq Composite up 11.8%. The Dow's still in the green too, up 5.4%. So yeah, it's a bad day, but taking a zoom out, we're just down to levels that we saw in June.
Markets go up, markets go down. The other thing that is interesting, and we talked about this, we kicked off our 2 p.m. hour with this, is that the NASDAQ 100 at this hour is down about 11%, almost 11% from that July 10th high. So technically a correction. Do investors say more downside from here, or do investors say, okay, that's an opportunity? Some of the fluff maybe has been taken out, some of the high expectations, the AI ROI maybe out of some of these names, and is that an entry point?
Stocks still up more than 10% this year.
Again,
down 5% today.
Context perspective, that's what we're all about. Hey, listen, do not go anywhere. Right now we're heading over to our TV colleagues. We are going to count you down to the close on this Friday, wrap up the trading week. That's because the closing bell starts right now.
Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
We're about 2 minutes away from the end of the trading day. Scarlett Fu and Alex Steele here to take you through the closing bell. It's a global simulcast, which means that we have now brought in Carol Massar and Tim Stenovic to help make sense and really show you the numbers here and show you the context of what's going on in the equity markets. Welcome to our Bloomberg television, radio, and YouTube audiences worldwide. Carol Massar, I think we all knew when the opening bell was about to ring that this was going to be a brutal day given the jobs report we got.
Interesting day, but you know what I find fascinating is that we're not seeing, at least right at this moment, some selling into the close, that we are off our worst levels of the session. Yes, a technical correction, 10% on the NASDAQ 100 from that July peak. But having said that, I don't know. I feel like we've had a lot of guests who said, let's take a breather. It's one report. We know there's a trend. We're concerned about a weakness, but the world isn't falling apart.
Yeah, that's exactly what Torsten Slok told us from Apollo. He joined us at the top of our hour. And he said, look, I changed my view after we heard from the Fed yesterday, and I changed my view after seeing the data today. We do think the Fed will cut in September, but he said this is just one data point, and he still pointed to a lot of alternative data that showed that what he believes is a very strong U.S. consumer and a very strong economy.
Well, what's come up in the last hour for us is that the narrative has changed. Like the story has changed. You can parse through the data in a different way, but overall, that's kind of what we're dealing with. And you can definitely see that if you just look at the VIX, not only the jump, but the VIX curve and how quickly we've re-rated. Even the volatility of the VIX has been impacted significantly, and holding that volatility regime higher would also be another shift for the markets. All right, those are your closing bells. Whew, we made it there. Volume quite elevated. We're still settling out here, but it looks like we got the Dow Jones Industrial Average off by 1.5%, S&P off by a little less than 2%, the NASDAQ off by 2.4%, and as Carol, you were saying, it could have been worse just even a few hours ago.
Yeah, absolutely. All right, folks, so staying with the big cap names here, the S&P 500, 372 names to the downside, 131 gaining ground. But I just want to point out, guys, you want to guess what the worst performing name in the S&P 500 is this week?
Not Intel?
It is Intel.
Oh, okay.
Over to you, Scarlett.
Hey, Scarlett, good guess.
Well done, well done.
I pass. Okay, let's take a look at how the sector performances shape up. You see a lot of red there, and that is mainly because of weakness across 8 of the 11 sectors. Consumer discretionary losing 4.5%. Financials down 2.4%. Energy losing 2.25%. Tech, by the way, is only off by 2%. I mean, there's 4 sectors that have fallen more than tech. What's notable, of course, is those that have bucked the decline. You've got consumer staples, utility, and REITs. Definitely a play for defensive sectors, for sectors that pay out consistent dividends and that are supposed to do well in tough times.
All right, guys, let's get to some of the individual gainers. And we talk about, sometimes market rotation. We'll get to that, and I'll show you why I say that. First of all, though, Apple did eke out a gain at its highs, up 3.3% in the trade, finishing the day with a gain of about 0.7%. So it was one of the top gainers throughout the day on the NASDAQ 100. Analysts optimistic about the company's iPhone 16 launch and AI rollout plans. Apple did predict that its new AI features will spur iPhone upgrades in coming months, helping the company reemerge from a sales slowdown that has hit as China businesses, especially hard. So upbeat third quarter results, mostly we know, we broke it down last night, but those sluggish sales in China. So here's what I talk about market rotation a little bit. Clorox is your #1 gainer in the S&P 500 today. Shares jumping up 7.5% here at the close. Company reported fiscal fourth quarter adjusted EPS that topped the average analyst estimate, issued a better than expected profit outlook for the year. And on to DoorDash we go. This one finishing just off its highs, up more than 8% today. #2 gainer in the NASDAQ 100. The company's third quarter adjusted EBITDA forecast coming ahead of consensus estimates. It also showed delivery order growth, so few gainers in that Friday trade.
Yeah, just a few. There were a lot of decliners, though, that I could choose from. And in fact, every single decliner on my list today fell at least double digits. I got to start with Intel. It's down 57% so far this year, guys, after today's drop of 26%. It's the biggest single-day drop going all the way back to the early 1980s when Bloomberg started keeping track, perhaps going all the way back to its IPO. Right now, trading at levels last seen since 2015. It shed more than a quarter of its value today. The company gave that grim forecast. It laid out plans to slash 15,000 jobs. It signaled that they're ill-equipped to compete in the artificial intelligence era, also suspending dividend payments to shareholders starting in the fourth quarter. And it's going to continue that until, quote, cash flows improve to sustainably higher levels. The company has paid a dividend going back to 1992. Shares of Amazon falling by 8.8%. Closing by 8.8%. At one point, it was down 10%. Shares falling the most in more than 2 years. Shares fell after the company told investors that profits for now will take a backseat to heavy spending on AI. Amazon said that operating income for the current quarter that ends next month will be $11.5 billion to $15 billion. Analysts were looking for $15.7 billion. And then check out what shares of Snap did today. They fell 27%, which for... a lot of other companies, that would be a superlative going back the most since, in many years or the most ever. Well, it's just the worst day for Snap since going back to February when it fell 35% in a single day. So it just shows the volatility and the big one-day moves that this company makes. The company did report disappointing second quarter sales. It gave a lower than expected outlook for earnings in the current period. Actually did see stronger user growth, marking a step back in the company's years-long quest to rebuild its core advertising business. But still, second quarter sales and lower than expected outlook disappointed investors. Shares of Snap finishing the day down by 27%, down 45% so far this year.
Yeah, it's also because Meta did well on ads, so I wonder if there was also a tough comp on that one. All right, guys, bond market super active today. Buying across the curve, but the buying in the front end was very dramatic. You're looking at two-year yields on the day down 26 basis points, but on the week, the two-year yield is down 50 basis points. That's the kind of move that we saw back in March of 2023 when the SVB crisis bubbled up into view. And just to point this out, the 210 curve steepened the most since 2022. I mean, these are really deep superlatives in a bond market that has been very whippy and moved a lot very, very fast.
All right, so you might, as an investor, think you've had a rough week. But if you are an investor who also rides New Jersey Transit, you've really had a rough week. I don't know if you guys saw this story. It's among the most read. It just starts with this. One passenger suffered repeated panic attacks. Another held hands to try and comfort each other. Firefighters attended to at least 2 people with medical issues. Business workers shed layer after layer of clothes drenched in sweat because a New Jersey Transit train last night got stuck underground and then the air conditioning didn't work.
Wednesday evening.
Wednesday evening.
Oh
my God. Sorry, Wednesday evening.
By the way, the context here is there's a bit of a heat wave in the Northeast. I mean, the humidity is out of control. Every day it's like 89, 90 degrees,
like
but
a
it
sauna
feels like 95 degrees.
Yeah.
This is the stuff of true nightmares. Like, this is the stuff that, you never want to have happen to you and that you get, maybe it's just me, guys, I don't know.
No. This
I
is
do not want to be stuck
you can get heat stroke and stuff.
under a body of water in a train with no power, no air conditioning, and no idea when this thing is going to start moving. Apparently, only Verizon service worked on the phone, so passengers were giving each other their phones so they could make calls and make adjustments. They ultimately got towed back to Penn Station. Some people
where they started from, by the way.
They had to get a diesel engine from Amtrak to tow them back to Penn Station.
Did they get I don't know, Krispy Kreme cards or something?
I don't know.
Yeah,
infrastructure. Can you imagine getting back on a train after that?
You can't blame anyone for wanting to leave the tri-state area and going maybe down south to Florida, right? The problem there, though, is that you have impossible traffic because so many people have the same idea. They're all moving to Florida, and now you're stuck in gridlock all the time. The cities in Florida don't necessarily have the infrastructure to deal with this influx of people who have come in and have stayed since the pandemic.
Wait, so that's seriously a thing? So now we're looking at crazy kind of traffic, but now in Miami because all the New Yorkers left and went there?
It's costing commuters an average of 70 hours each year, and that adds up to, according to one estimate, $3.1 billion in losses.
What are you going to
throw out there? Is it public transit, infrastructure?
That's a big problem,
investment there? Would that sort of alleviate some of the pain that we're talking about?
But do they have public transit in the same way that we're used to? No, right?
8
out of 10 have driver's
license, right?
Yeah.
8 out of 10 have driver's license. So there is no mass transportation.
How do you do that? Do you raise taxes in order to pay for that? Or
no, you can't do that. It's Florida, right?
Well, then what do you do?
You got to hit the road.
Oh, wait.
That's what you do.
Ken Griffin, wait, you came down. Maybe you can help us solve this problem?
Maybe it's a private. Maybe it's a private thing.
There are private solutions, but they cost. Yeah, they cost money.
Got to call Elon to build build the boring company tunnel there, right?
I love those tunnels.
Yeah.
I think it's a great idea.
No, if it's actually implemented.
All right, you guys, stay cool. Hopefully it's going to ease a little bit.
I hope you don't take New Jersey Transit.
I was like,
home,
good
by
luck
the
getting
way.
home, Carol.
I'm getting into a tunnel very soon, guys. All right, have a great weekend, you guys. That's a wrap. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals, folks. We will see you again, same time. Some of us, I think Tim's going on vacation.
That's okay. I'll see you guys soon.
Yeah, but we'll see you guys on Monday.
Safe travels, Tim.
Thank you.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenivek on Bloomberg Radio.
It is Bloomberg Business Week. That's Carol Masser. I'm Tim Stenivek.
Grabbing my
Friday,
earbuds,
everyone.
sorry.
Carol's just
falling
getting ready. Look, as we've been talking about all day, the big story is what happened with that labor report. The U.S. hiring slowed markedly in July. The unemployment rate rose to an almost 3-year high, raising concerns about a recession, putting the Fed solidly on a path to cut interest rates. The bond market, Carol, doing its thing following the data. We just heard the numbers on the week from Alex. Yields plunging across the curve. The Fed policy sensitive 2-year ended up finishing the day down by 26 basis points. But we saw the 10-year fall by, let's go ahead and call that 18 basis points.
Did she say coming in like 50, 60 basis points over the week? I mean, unbelievable.
Yeah, really nuts.
So let's get to it. Like one of our favorite people on rates. We're so grateful he's here on a Friday in August. Michael McKenzie back with us, Bloomberg News rates reporter here in our Bloomberg Interactive Broker studio. It is interesting because, you know, on a day where we see stocks selling, it's very easy to get caught in it, but it's really all been about the rate moves that we've seen, right? And the renewed expectations this week, kind of the rethink a little bit. And that's why we're all kind of like, okay.
That's why you're the most popular guy around.
Well, I don't know about that.
You are.
No, I mean, it's the story of the week. In fact, if you go back to July 22nd, when I think the 2-year was around 450, it's been picking up steam. And at the same time, you've seen commodity prices for base metals, they've been sliding. You've seen the carry trade in Japan start to really unwind. It got impetus this week when the Bank of Japan raised rates. And so what you're seeing here is a real risk aversion starting to take out. And that's why the stock market's really fell apart yesterday. And that was the harbinger of what we saw today. And it is about the economy, but it's also a global story as well as a US story. And there was this idea not so long ago that the US was, you know, dominant, exceptional, US exceptionism. That's now in question. And I think that's really what the bond market's been sniffing out since about mid-July when we saw that CPI number come in softer. Then the market started paying more attention to some of the data, and you could see there's stress going on. And coming back to the stock market, all the big earnings results, you know, have focused on a consumer that is pulling back and retrenching. And this is a consumer that's probably finding it harder to get jobs, less willing to change jobs, and it's all starting to come together as in a sort of typical slowdown growth scare picture that we've been through before. And the real question, the unknown at this point, is does this turn into something worse?
Yeah.
And then where does this put the Fed?
Because part of what you're talking about is exactly what the Fed wants to see.
They
this
do.
is what brings inflation down. This is the reason for raising interest rates in the first
And
place.
as someone I spoke to this morning said, inflation is yesterday's news. And their view is rates need to come down. And that even if the Fed cuts to 4%, that's still too restrictive.
Rates need to come down between now and September?
Well, JP Morgan today changed its Fed call. They're now calling for 2 shots of 50 basis points cuts starting September and then following in November.
So more like a 3% Fed funds rate?
Well, below, you need to get back to neutral, which is anywhere between 3 to 3.5, depending on who you speak to. And this gets back to what we've been writing the last couple of weeks. And we've actually seen traders putting on these 50 basis point potential trades coming to fruition in September, because at the back of their mind was, there's a long time before that September 18 meeting. There's a lot of data to come. Now, to back it up a bit, talking to other people this morning, they're like, okay, Mike, the number wasn't great, but I really need to see an unemployment rate of 4.5% and a really bad payroll number in the first week of September for me to get on board with where this Treasury market's gone. So there is a debate, but there's no question that the flows are really helping bonds. And I'd say there's 2 other factors here. People who have been sitting in Treasury, sitting in stocks, as one asset manager told me today, They are seeing people bailing out on stocks. They're still making money. They've been in the stock market for a long time, but it's time to rotate out of stocks, go to bonds. And then the other thing, of course, is you still got $6 trillion sitting in money market funds, earning 5% at the moment, which looks great. But the whole curve out to 10 is now below 4%. That's still a good level to buy. And so next week we get the refunding. So we get new sales at 10 years and 30 years and 3 years. But the 10-year will be the one to watch. And I wouldn't rule out the 2s, 10s curve finally going into positive territory next week on the fact that the 10-year yield will back up in order to take down.
We don't just
portion.
go flat and just stay there.
Go flat, but again, and the scary thing then is what you need to watch here is how fast does the curve steepen from here?
Right.
Because the faster it starts to steepen, that's your recession signal.
You know, what's crazy though, Michael, is I feel like we can have, I know this is one data point, but it does feel like the momentum or I forget what the words were that like Claudia Sam told us. It's like the trend line, and the momentum is going though in a very specific direction.
It's all starting to fall in the same place.
But there is a lot of data between the next Fed meeting. And so, including another jobs report, like could things shift a little bit?
It can, and I think, look, the jury's out on whether the Fed's called this right. I mean, people are very quick to jump on and say, hey, you know, the Fed missed the inflation pickup in 2022. They were too slow to start, so they had to go and deliver 4 75 basis point hikes. They really had to catch up. So the question now is they've had rates on hold for a year. They did open the door to easing in September, but from their point of view, it's going to be methodical and measured. But the bond market is definitely calling into question whether it can be a measured pace. And given the strains that we are seeing for the consumer from various things, particularly from CEOs talking on their earnings calls, there's something building out there.
I think what's interesting is if you would have gotten, you know, last month we got a stronger than expected payrolls report. I think if we would have gotten this report last month, bad news would have been good news for the market because then they would have seen a cut coming up.
Yeah, and I think the other thing too is that even if the headline number had come in stronger today, people would have looked at the revisions. They would have looked at the unemployment rates. A lot of focus on the SARM rule, whether you agree or not. And even Claudia herself has said, look, it may not be correct this time.
She's on our air a little earlier.
Kudos to her. But I think the key point here is that all the other data around employment doesn't look great. So the ISM employment number this week was bad. Next week, the only real piece of good data key data we get is the ISM service sector. That has an employment component. That's the one to watch because if that comes in weak, then you can start to feel that, you know, the bond market's on the right side of this.
So we've talked with you about Fed policy having a lag effect.
Yes.
So are we at that point where like it's all being felt? Like where are we? Like if
I think that's the way to summarize it. I think people often look. Labor is always the last shoe to drop. You talk to people down the years who've been through different cycles. The labor market is the last one that cracks, and when it cracks, the worry is it tends to go pretty quickly. You don't just see a nice nudge up in the unemployment rate; it tends to jump a lot. So that's going to be the issue for the Fed when they, you know, and again, I think a lot of attention now is going to be focused on Jackson Hole because that's when, because as someone I spoke to today said, Powell now has to do the communication job.
Yeah.
And that's what we've got really nothing next week apart from the refunding and the ISM.
He did that 2 years ago in August of 2022 when he sort of squashed this rally and said financial conditions are, you know, need to be tighter. How does he thread that needle August 22nd when he addresses everyone again?
Well, if you look at financial conditions, they are now getting tighter. Stock sliding, you know, commodities coming off hard. That's a real classic early warning signal that the economy is slowing down. So I think he's probably going to keep the focus on their dual mandate. And under those circumstances, you can see why banks like JP Morgan and Citi today have said they're going to do 50. And even Rick Reeder was on the television this morning after payroll saying they should have cut this week.
Bill Dudley, right?
So again, and I kind of feel bad here for the Fed because it's easy to knock them. They're trying to really slow down a super tanker and do the perfect turn. That's really hard. But if they really want to guarantee a soft landing and something that at the moment feels like a growth scare from becoming something worse, they probably need to be preemptive. And the other key point I'll add here too is the mortgage market is going to be really important for the consumer.
Yeah.
Because 80% of mortgages cannot be refinanced until that 10-year gets below 3%. And if you really want the consumer to,
Still have a ways to go.
to be good and to use their house as an ATM, they've got lots of positive equity there, you need to get rates down fast, but you need to get that 10-year down. So that's going to be the challenge for the Fed, potentially.
But they don't want to do too much because they don't want inflation to rear its head.
Oh, this is the whole thing, right? That's why economists always talk about on this hand and that hand, right?
Have a great weekend.
You too, guys.
Great way to wrap up for us. Michael McKenzie, Bloomberg News rates reporter. This is Bloomberg.
It's 4:21 on Wall Street. We do check markets all day long here at Bloomberg. On to the weekend after a brutal week for the U.S. stock market. The Dow, the S&P, NASDAQ all plunged today. We had the S&P dropping 100 points to 53.46, ending the week there. Lower today by just about 1.8%. Now, for the week today, we did see the S&P lower for a third consecutive week. The S&P today down by 2.1%. Bottom line here, jobs Friday, stocks sold off. S&P, as I mentioned, down 1.8%. The Dow down 1.5%, lower by 610 points. finishing the week at 39,737. NASDAQ, the composite index, down 418, down 2.4%. The NASDAQ 100 index also down 2.4%. The Russell 2000 hard hit, down 3.5%. 10-year yield 3.79%, with a 2-year 3.87%. Spot gold down 0.3%, 24.37 the ounce. West Texas Intermediate crude down 2.9%, 74.12 for a barrel of WTI. Bitcoin down 2.8%. Bitcoin below 63,000 this Friday, 62,896. Intel plunged after earnings today. Intel down 26.1%. Amazon down after earnings, down 8.8%. Apple after earnings had an up day, holding on to a gain of 0.7%. Again, recapping, a 100-point loss today, another losing week for the S&P, down today by 1.8%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Do appreciate it. Well, the market and the softer than expected payrolls report, certainly a top story today. So this other one got a little lost in the shuffle. JP Morgan Chase
I'm so glad
CEO.
you're talking about this one.
This was,
It did get
you wake up this morning before, and I mean, this is when I woke up,
Yeah.
and this was like a headline
Yeah.
this morning.
Go through it, yeah.
JP Morgan Chase CEO Jamie Dimon said the next U.S. president must work to bring together a, quote, deeply divided nation as domestic and geopolitical issues mount, and said the business world should have representation in the cabinet. Here's what he wrote. The private sector has huge wells of expertise and produces 85% of our nation's jobs. This was in an opinion piece published early this morning in the Washington Post. It should have a seat at the table. Yet in recent years, government leaders have often failed to engage those in industry. A president should put the most talented people, including those from business and the opposite party, into their cabinet.
So a quote, seat at the table. Jamie Dimon is talking about is representation, having those who are in the private sector helping to shape policy, giving those in business a say in government. At its core, this is really governance.
It's an important concept, not just in politics, but also in business, and that's corporate governance. Bryce Tingle is an expert in it. He's a business law professor at the University of Calgary, and he's got a new book out. It's called Hard Lessons in Corporate Governance. Professor, good to have you with us this afternoon. How are you?
Good, thanks. Thank you very much, Colin. Tim, I'm delighted to be here.
So I just want to start with the failure of corporate governance here in the U.S. Where do you see examples of it failing?
Sure. Well, it fails in two different ways. One is, for the last 30 years, we've really changed the way companies are governed. And as I detail at length in the book, we've studied the outcomes, and the changes we made either don't make any difference to the way corporations work, or they make things a little worse. And you can see that, we really started experimenting with corporate governance in the early 90s. And you can see that in things like the dot-com collapse and some of the bad behavior that led to the 2008 financial crisis and stock option backdating and executive pay. So even if you're not really familiar with the empirical literature, at this point it's becoming pretty obvious that what we were doing isn't working. But the second way that governance fails is we've made it really unpleasant to be a company that's subject to our corporate governance rules, and those rules live in the public markets. And so we have seen over the last 20 some odd years a growing reluctance on the part of American businesses to join the public markets.
So, going into, it's funny, I was thinking about, we talk about public markets versus private, and I do wonder about how that plays into it because, when you've got folks like us who are covering companies on a quarterly basis, there are certain metrics that we measure them by, right? And certainly investors do. And I do wonder how that kind of gets in the way of maybe doing better when it comes to corporate governance. So have public markets failed us?
I think public markets are failing us. I don't think I'd use the past tense. They're failing us because we all depend on new innovative businesses coming to the public markets and making themselves available for the average investor to invest in, and exposing their business in the way that your show permits. You get a lot more transparency in the public markets. And so if the public markets aren't doing the job of attracting new businesses into them, they're beginning to fail. They're about half the size they were 20 some odd years ago.
Let's talk compensation and executive compensation here, because let's be honest, I think many people would argue it's gotten a little out of hand in terms of pay packages.
You have a chapter devoted to this.
For executives of U.S. companies. What is the relationship between governance and executive compensation?
Yeah, that's an excellent question. In some ways, compensation is what got us started in making all the changes we have over the last 30 years. The notion behind modern governance is that we're trying to control the behavior of managers. They're in the situation where they have custody of the shareholders' property, that is the assets of the business, and we want to prevent them from misusing them or dealing with them in a self-interested way. And the most obvious way for them to do that is obviously with executive compensation, paying themselves too much. And so right from the early days of the modern corporate governance regime in the early 90s, we saw sustained efforts on the parts of multiple parties, including U.S. Congress, to control executive pay. And I think at this point, we can all say that everything we've done is a failure.
Yeah, the salaries might have been reduced or have stayed stable, but total compensation has gone through the roof.
Yeah, it now takes more than twice as much of the profits of a company to pay its most senior executives than it did back in 1992. So yeah, it has been a failure. The thing I point out in my book is that the very things that we tried as part of our corporate governance reforms actually were the things that led to this huge increase in executive pay. The truth is executive pay had stayed pretty flat from the end of the Second World War into the late 1970s, and then it rose only very slightly in the 1980s. The time when we start experimenting with corporate governance in the early 90s is when executive pay just explodes.
You know, we were thinking about a couple of companies, to be quite honest with you, when Tim and I were prepping for this, Bryce, and like Tesla, good corporate governance. Boeing, good corporate governance.
Why are you laughing? He's laughing when you ask
Fox,
Tesla.
good corporate governance, which we've all been talking about, kind of a real life succession drama playing out.
Yeah, well, let's take Tesla, because Elon Musk is always the most entertaining. So you can have a couple views about that Tesla pay package. I mean, of course, it seems like it's absurdly too big, but the $58 billion, maybe $52 billion, if you parse the numbers carefully. The Delaware court threw it out. And what's interesting is the total irrelevance of the reason the Delaware court threw it out. So the Delaware court threw it out because it said Elon Musk has got too much power, and the independent directors on the board of Tesla weren't really independent. And they didn't disclose to the shareholders at the time the shareholders voted back in 2018 that they weren't as independent as maybe the shareholders assumed. That, in a nutshell, is what the court held. And that strikes lots of people, including the shareholders who voted again to award Elon his pay package just a month ago. Strikes a lot of observers as dumb and kind of irrelevant. It was clear in 2018 that Elon Musk was the driving force behind Tesla. And the size of his pay package, the terms on which it was made available to him, was well reported by the financial press. It was fairly and accurately disclosed in the materials that were sent to the shareholders. It would have been no trouble for the shareholders to evaluate its impact in terms of dilution, and they voted in favor of it. It's safe to say that no shareholder cast their vote under a mistaken belief about the independence of Elon's board, yet that turned out to be crucial for the Delaware decision. And it's a sign of the way in which our beliefs about corporate governance have begun increasingly to diverge from reality.
We only have 20 seconds left, but what about Fox Corp, News Corp? Because there's this great New York Times story last week about the secret battle for the future of the Murdoch empire. Very briefly.
Well, that's a great question. I'm not sure I can do it just in 20 seconds. But it is a sign that often the most important parts of corporate governance aren't about who's the independent director or whether or not the shareholders have majority voting. It's about the character and personalities leading the company.
All right, we're going to have to leave it there. Thanks so much for joining us. That's Professor Bryce Tingle. His new book is called Hard Lessons in Corporate Governance. He's business law professor at the University of Calgary, joining us from Calgary.
It's a really timely topic. We kind of talk about it a lot, corporate governance. All right, folks, let's get to World and National News. Off to Nancy Lyons we go, back to D.C. Hey, Nance.
Hey, Carol. The virtual roll call vote by Democratic delegates to pick a presidential candidate is not slated to end until Monday, but the Democratic National Committee says Vice President Kamala Harris today secured enough delegates to win the nomination. She says she's honored to be the presumptive nominee and will accept the nomination officially next week. Former President Trump says there is no reason to participate in a presidential debate against Vice President Harris. He says everybody already knows both of them. He spoke with Fox Business.
There is more enthusiasm for how can you be enthusiastic? How can you be enthusiastic about Joe Biden? Okay. I mean, how do you mean? But I think she's actually worse. I think she's a horrible candidate because she wants open borders. She was a border czar. She tries to, deny that now, which is not working.
The Harris campaign is launching a new strategy and running ads in papers in the city where Trump plans to hold rallies, saying that he's afraid to debate after first saying that he would debate anytime, anywhere. FTC Chair Lena Khan says her agency is taking a look at grocery prices and why profits for grocery chains remain so high, even though costs appear to have come down. Grocery prices have spiked by roughly 25% over the past 4 years, 5 percentage points more than consumer prices overall. Khan says no American should be paying inflated prices due to illegal business practices. Justin Timberlake is pleading not guilty to DWI charges in New York. The 43-year-old pop star made a virtual appearance today, and the judge suspended his New York State driver's license. Timberlake is accused of swerving multiple times and blowing through a red light in Sag Harbor on June 18th. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Nancy Lyons. This is Bloomberg.
It's 4:40 on Wall Street. We do check markets all day long at Bloomberg. Worst jobs day since October 2022 for the S&P 500 index. The Dow, the S&P, NASDAQ all ended the day deeply in the red, with the S&P down 100 points, falling 1.8% today and lower for a third consecutive week. The Dow down 610 points, lower by 1.5%. The NASDAQ Composite Index was down 2.4% today. NASDAQ down 418 points. The Russell 2000 Index of small cap shares down 3.5%. 10-year at 3.79%. The 2-year 4.86%. Spot gold was down 0.2%, $24.41 the ounce. West Texas Intermediate crude oil down 2.9%, now at $74.11 a barrel. Today's sell-off came after a weak jobs report that fueled worries that the Fed's decision to hold rates at a 2-decade high is risking a deeper economic slowdown. Earlier today on Bloomberg Business Week, we talked to Andrew Cry, the co-CIO of Crescent Grove Advisors. And here on Bloomberg Business Week, he says you got to focus on the broader labor picture.
You look at the other measures as well, whether that's ADP, whether that's challenger job cuts, whether that's JOLTS data, all these sorts of things. The overall mosaic, initial claims, ongoing claims as a percentage of the labor force, all these sorts of things suggest to us that we're just cooling off of a extremely hot level. So I don't know that this dramatic of a response is warranted in this case.
Andrew Cry of Crescent Grove Advisors, interviewed right here on Bloomberg Business Week. Again, the S&P down today by 1.8%. Very tough day for a lot of big tech names. Case in point, we saw shares of Intel today plunge by 26%. Amazon, after earnings, down 8.8%. Apple had an up day, little changed, actually changed by 0.7%. Again, recapping, the Dow, the S&P, NASDAQ ending the Friday session in the red, S&P down 1.8%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Thanks so much for that update, Charlie Pellet. Well, we've all been there. You run out of deodorant or toothpaste, so on your way home from work, you stop by your local pharmacy chain, only to find said sundries being held hostage behind plastic barriers.
Let me out! Let me out!
To negotiate their release, you'll need a key-wielding store employee. Since nobody's around, because nobody is ever around, you press a call button and hope for the best. When nobody shows up, you probably think to yourself, easier to just order this online and go a few days without deodorant. Because after all, I have to sit next to Carol Masser, and who cares if I smell for 3 hours when I'm sitting right next to her?
For the record, I do care, so buy that deodorant. I gotta say, this story, I want to do a table read with a bunch of actors because it is just brilliantly written, and it's just charming, although it's not charming when you actually have to push those buttons and get one of these items. Let's get to Bloomberg Business Week senior reporter Amanda Mull. She writes for the magazine how CVS, Target, and other chains have barricaded everything from toiletries to cleaning supplies. It seems sometimes, though, random, and how it's backfired in almost every way.
It's an undies heist.
It's an undies heist. Oh, my God. Amanda, you just are so speaking to us. First of all, can I share some video with you, if I may?
Can she see the video? I don't know if she can see the video.
I don't know if you can see this video. I'm going to describe it also for those who are listening on radio. Tim and I, last month, were in Seattle for the Bloomberg Green Festival. A lot of fun, great city. I am showing video right now of a Target that I walked through, and literally it was just aisle after aisle of everything behind bars, glass bars. Like there was nothing, it felt like, that I could just kind of pick up and think, do I want to buy it? Might I want to buy it?
You didn't steal anything, did you?
I did not steal anything, but it blew my mind. It was everything behind locked glass cages. We know kind of what's going on, but it feels like really extreme. Just remind everybody who might not be familiar.
Well, since the pandemic especially, a lot of stores have taken to putting, especially personal care and household cleaning goods, a lot of really everyday things, deodorant, laundry detergent, toothpaste, toothbrushes, all kinds of regular stuff behind locked glass shelves in their stores. The retailers say that this is because of large-scale rings who are just coming in and cleaning them out. That type of theft does certainly exist, and it has gotten worse for some retailers in some places. But based on all the reporting that I did, like that excuse does not totally stand up to scrutiny. And there's quite a few other things at play in why they're doing it. But ultimately, it just really, really frustrates customers and seems to not be working out great on the whole.
Okay, the job of the store is to sell things to consumers.
Buy me.
Right.
Why are they making it so difficult then for people to buy things?
Right. We as a society have decided that we are going to distribute like the everyday necessities of life through the retail system. Like that is how we're supposed to get it. And if you can't walk into a store, which is the modern stores as we know them are set up to be self-service. That is so that people buy more, so you have lower labor costs. That is like the entire system that like everyday interaction with goods and services is based on in the United States. And the locked shelves basically break that system. And because, it takes a lot of labor to open and close those shelves, you don't really see an increase in labor in the stores that use them. And it's a system that's not working. People buy less, people browse less. It's not going well.
That's what's kind of wild. I mean, right? You want people to just wander and buy. Man, I've certainly done it, and all of a sudden your Target, cart goes from $30 to $250 because you threw stuff in there. Problematic. And I think what's so core about your story is that ultimately, right, shrinkage has happened, but the bottom line may be worse for some stores, but overall the number has been pretty consistent, even though we're talking a lot more about it.
Right. What you see over time is that the, shrink is the industry term for the percentage of lost inventory as a percentage of total sales. So if you lose 1.5%, if you have 1.5% shrink, what that means is that you, of all the sales you did, 1.5% of that total inventory cost was misplaced, stolen, something happened to it. You didn't get to sell it. And that has been like pretty consistent, with a tenth of a percentage up or down here and there for years now. We don't see a lot of overall shrink changing, and shoplifting, organized or otherwise, is part of that percentage of shrink. So it's really hard to see on the outside where all of these huge losses actually are. And stores are generally not very forthcoming about data.
So why are they doing it?
This is speculation on my part, but based on my reporting and all of the industry watchers and experts that I spoke to for this story, but I think that a huge part of it is that, there's a real staffing problem in retailers across the country, especially in more expensive cities, which is where you see a lot of a higher usage of these locked shelves. It's very hard to get people to work in stores under the conditions of retail work in America for the amount of money that retailers are willing to pay. And if you have more people in stores, better staffed stores, that keeps shoplifting down. That reduces shrink overall because you have, less mistakes made in other places in the store as well, which also contributes to shrink. So you keep shrink down that way, but retailers don't want to fully staff up. They don't want to pay more. They don't want to hire more workers. So you have to do something to keep stuff on the shelves, and that's these barriers.
Yeah, but you do wonder what the longer term impact. I mean,
you just order from Amazon or whatever because you're so sick of it.
Right. Exactly. If I'm going to walk in and I can't
that's
even get to stuff.
That's got to kill the business too.
Yeah.
Right. This is a real short-term solution. Long-term, you're just turning, and I talked to so many people over the course of the story, you're just turning people to online sales. Yeah. And those online sales are usually not going to come from your company. They're going to come from Amazon, probably.
I just love too, though, and we're running out of time, but like you say, it just seems sometimes random, right? Like you said in Target, the replacement heads for electric toothbrushes were encased, but regular toothbrushes weren't. It's almost like a version of social media, like being liked or chosen to be locked up, like you're worthy, like you need to be locked up to be protected. It's a very weird world to live in. Anyway, we are going to arrange a table reading.
So good.
Because it's just precious. It really is. And unfortunately, this is our reality. Amanda, have a great week. And Amanda Mull, senior reporter at Bloomberg Business Week. We knew we were going to love it. Elizabeth, thank you for suggesting our producer. So great.
your company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. Chevron is relocating its headquarters to Houston from California after repeatedly warning that the Golden State's regulatory regime was making it a tough place to do business. Chevron Chairman and CEO Mike Wirth spoke earlier today with our Alex Steele.
Look, we've had some policy differences with California, and certainly California and Texas approach energy very differently. And so we speak up on that. We advocate for policies that keep prices low, that keep supply reliable, that encourage investment. And California's advanced policies that do the opposite. And so we've certainly expressed our views that we don't think that's good for the California economy. But this isn't a move about politics. It's a move about what's good for our company to compete and perform.
Chevron CEO Mike Wirth on Bloomberg Television and Radio. The move came amid a shakeup in senior leadership ranks, apparently aimed at improving results today. Chevron shares down along with the price of oil. Chevron today down by 2.7%. Also moving lower today after earnings, we did see ExxonMobil decline by just about 0.1%. Intel had its largest decline in more than 40 years, roughly 40 years after the company gave a grim growth forecast and laid out plans to slash 15,000 jobs. Intel today plunged by 28%. Also after earnings, we had Amazon.com dropping today by 8.8%. On the upside, though, Apple up by 0.7%. It's predicting its new AI intelligence features will spur iPhone upgrades in coming months. And those are our top company stories at this hour. I'm Charlie Pellet, and this is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio and Television.
It's Bloomberg Business Week on this Jobs Friday. Let's get a check on the latest world and national news. We got Nancy Lyons in the Bloomberg 99.1 newsroom in D.C. Hey, Nance.
Thanks, Tim. The U.S. Secret Service is given an investigation update this afternoon and does admit to shortcomings in security at Donald Trump's rally in Butler, Pennsylvania, where a gunman fired at the former president. Ronald Rowe is acting director of the Secret Service.
The Secret Service takes full responsibility for the tragic events of July 13th. This was a mission failure.
Rowe says if Secret Service personnel committed policy violations, they will be held accountable. Kamala Harris has secured enough delegate votes to become the Democratic nominee for president. The vice president crossed the threshold of delegate votes during a virtual roll call today. Harris will officially accept the nomination next week. Do not expect to see a debate, though, anytime soon between Donald Trump and Kamala Harris. Trump, appearing on Fox Business's Mornings with Maria, says he does not need to debate the vice president.
If I didn't do the debate, they'd say, oh, Trump's, not doing the debate. That's the same thing they'll say now. I mean, right now I say, why should I do a debate? I'm leading in the polls. And everybody knows her. Everybody knows me.
Harris has been pressing Trump to follow through with a scheduled debate on September 10th that was to be hosted by ABC News. As for the polls, a Bloomberg News Morning Consult survey conducted from July 24th through the 28th found Harris erasing Trump's lead among voters in 7 battleground states that are likely to determine the election. Harris is backed by 48% of voters to 47% for Trump. TikTok is being sued by the U.S. for allegedly collecting data on children in violation of an online privacy act. The Justice Department says the app, that's owned by the Chinese company ByteDance, has allowed millions of children under the age of 13 to create accounts without their parents' knowledge or consent. And officials say TikTok made it hard for parents to request deletions of their child's account. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Nancy Lyons. This is Bloomberg. Now, back to you, Carol and Tim. Have a great weekend.
Thank you.
Yeah,
you
too.
Nancy. Appreciate that.
Enjoy. Stay cool, right?
Yeah,
Washington's been really, I was talking to somebody who was in Washington just talking about how steamy it is. It's super, super hot here. So everybody be really, really careful.
85 degrees here, heat advisory in New York.
It's like, it's one of those, when you walk out, you just feel like you hit a wall of heat.
Oh, it's 98 in Washington right now. Nancy, stay cool.
That is crazy, crazy.
Wow.
Hey, most read story on the Bloomberg in the past 8 hours. Yeah.
Okay.
In the past 8 hours, so all the S&P 500 has its worst jobs day since October of 2022. And then in the past 60 minutes, Wall Street's year of calm snaps as biggest market saviors flop.
Yeah, it's a great piece by Denitsa Tsakova, Isabel Lee, and Lu Wang, who write that for years, Wall Street had it all figured out. If the stock rally is in danger, pile into the big tech safety trade. Scared the economy is slowing down? The Fed has got your back.
It's not that way anymore.
No.
Well, we kind of kidded and joked that, for such a long time, bad news was good news because it meant, okay, the Fed's going to get closer to a rate cut, and that's going to be good, certainly for risk-on assets. And then all of a sudden, it's like, oh, wait, bad news, really?
That's why I wonder if this report a month ago would have still been treated as bad news. But now you got,
It's a great question.
You have to wait till September for a move. Well, you don't have to, but people think you're going to have to wait till September for a rate cut.
Yeah.
There are some folks out there who are saying you could see one before then, but the chorus is not growing.
I would think that would be.
They would look at it as like an emergency thing, right? Like during COVID, they were doing that.
A lot of data points to get through, as Jay Powell reminded us. Having said that, in the meantime, if you're staying inside or taking a walk, be careful, but catch our weekend show, 8 a.m. Wall Street time on Bloomberg Radio, our podcast feed as well. We do want to thank our team because, man, it's been quite a week with the news flow. Anthony Mancini, Colin Tipton, Steve Lanzone, Meredith Frank, Sarah Livesey, doing special duty on the weekend too as well, Justin Milliner, Paul Brennan, who's taking a few days off next week as well. Killing it today, our production team of CC Cherendoff, Elizabeth Cedrin, and Sebastian Escobar. Man, you guys rock. So appreciate it.
Thank you all to the whole team.
Yeah.
For just making this show so easy.
It takes a village to do all this stuff. And you, I'm going to miss you next week.
I'll miss you too.
Have a fun time off.
Thank you. I'll see you the week of the 12th.
Yeah. Be careful. Stay cool. Enjoy your time with your family. All right, everybody. Balance of Power starts.